This program proudly brought to you by IPO Wealth for the sophisticated investor.
Well, welcome to Money Talks. I'm Peter Switzer, and first show of the year. I sat down at my desk this morning thinking, what am I going to write for the Switzer report? And I thought the most obvious question all of us want to know is, after this massive sell-off we've seen since, well, August, September, October, maybe October really got hotted up. Yeah, is this a buying opportunity, or should we be waiting for another leg down? Now, to answer this question, I've got two of my favourite colleagues, namely Julia Lee from Bell Direct on my left, and on my right I have my colleague Paul Rickard, who also writes for the Switzer Report, but also was once upon a time the CEO and chairman of ComSec, and he's apparently been Julia's boss two times in her life. Twice in his life. But what I want to do is put out what I think is going to happen for 2019, whether this is a buying opportunity or not. But I don't want my view to be the only one here. I'd like to test it out with my colleagues who don't tend to suck up to me and agree with me all the time. So it'd be a great opportunity to actually toss around the issues of whether this is a buying opportunity, or maybe we should have to wait, or could there be another leg down, which exactly did happen in 2008. So without any further ado, the point is that the Australian stock market, the ASX 200 index, was down 11.3% from its August 12 high of 6,339.2. But the question is, has the market fallen enough for people to start thinking this is a buying opportunity and getting into the market? And later on, if my colleagues think it is the time to get in, we'll see what they think you should be buying. Julia, let's go with you first.
I think, first of all, 2018 was a very difficult one for investors. The first 3 months of the year were negative, and then the last 4 months of the year were negative. If you stripped out the first 3 months and the last 4 months, you would have done pretty well, up by 10%. But unfortunately, the volatility in terms of markets are signalling that perhaps we are at a bit of a turning point in terms of the global economic cycle. There's always reasons to be optimistic about the markets, but I'm a big fan of going back in time and having a look at history. And the last time we saw corrections for the Australian share market were in 2015 and then in 2011. And in both those cases, the corrections lasted around about 2 quarters. So we're about 4 months into this correction at the moment. And I think the buying opportunities will really come after the first quarter and probably after the half-year earnings season in February, which will be a key test for the Australian market.
So what you're saying is you're not seeing doom, boom, kaboom, Armageddon out there in the medium term, but in the short term, you would not be piling in saying, this is my buying opportunity, I'm going to buy right now.
Absolutely, because I'm an equity strategist, Pete, and so when I look at the market, the type of scenario where I love investing in the market, and the most easiest scenario is when earnings growth is increasing or accelerating. When the opposite is the case, it's a bit more harder to make money in terms of markets. But that doesn't mean that it'll last forever. No. And for the patient investors who understand that cycles don't last forever and the bad times don't last forever, 2019 is really probably the time that you'd probably make or break your wealth over the next 5 to 6 years.
Okay, Paul, you've heard Julia, and of course you employed her, so you have to think that...
Well, of course, I know she's going to be right because I employed her, Peter.
Yeah, but what's your view?
Yeah, look, I tend to agree with Julia. I'm a little on the fence at the moment, Peter. I think there are some positives, and one of the positives for me is that if you actually look at the figures for last year, the top 20 stocks, the top part of the market, didn't do so badly. In fact, it was only down 0.4% if you add in dividends. Most of the damage has been in the small caps and the mid caps. I think that's actually a positive for the market longer term, and that's I think there's
because they sort of power the index.
Well, I think if the market's going to go higher, it's always the big stocks that lead it up, and I think that's what you could see. So I think that's actually a positive. I think the other thing that, apart from any of the unique factors with President Trump, we are about to have an election in May. Elections traditionally are bad for stock markets, at least mainly for 2 reasons. One is markets hate uncertainty, Peter, as we know, but also consumers tend to delay some discretionary spending on things like cars and travel and appliances. So it does sort of almost have a bit of a stock market economic effect. Growth tends to wane a little bit in that quarter into the election. So traditionally that's a negative, I think, and also you perhaps with the change of government and largely a set of what you would describe as investor unfriendly policies. The question is how much of that's built into the market. So I think I'm a little on the sidelines at the moment. I'd like to say it's a buying opportunity. I think we've got to get. I'd be more inclined to say maybe post the election, but I don't think Armageddon's here, and I think it's a time to nibble carefully.
Okay, well let's agree then that both of you don't see Armageddon for the stock market for 2019, but you both agree that the starting point may well be a few months down the track. And
absolutely, and look, I think it depends on what market you're talking about. If we're focused in on the Australian market, then I think domestically we have seen a softening of conditions, whether it's the housing market, which has been softening off for a year now, whether it's new car sales, which are down 7 consecutive months, money supply, which is at a 26-year low. So these factors do eat into earnings, especially domestically focused earnings, things like retail, discretionary spending. So in Australia, look, the first half earnings season in February, I think is going to be an important one. And then over in the US, it's an interesting one too, because the economic data is still relatively strong, as we saw from the job numbers out on Friday, which were a fantastic set of numbers.
what, 315,000 versus the 177,000 that were predicted. Yep.
But then on the flip side, you consider the boost that earnings got from the tax changes over there, and we're probably going to see slowing earnings growth for S&P 500 companies. So what does that mean in terms of the share market? And then you obviously have China, which is a totally different cycle altogether, which is probably nearer to the bottom of their cycle rather than the top, and is looking at stimulus at the moment. So look, 3 very different markets, and I think 3 very different things.
Okay, I've got a slide here looking at the 4 big threats. I think a lot of my viewers would like to look at the 4 big threats. They'll be coming up on the screen. There they are now. So you've got Trump and the trade war, the Fed rate rise, chances of a US recession, and US profits. Now, it seemed to me, I noted in my story today, that the Fed rate rises and a US recession seem to be less of a worry now. If you guys agree with me, let's just nod agreeingly. But Trump and trade, the trade deal, seems to be a really important one. And if Donald Paul comes up with a solution where the market says, oh, that's better than we expected, or is at least good, do you think Wall Street will go for another jump up like they did when the Fed said, well, no, we're not going to raise interest rates unless we really have to?
Yeah, look, I think the US wants to buy the markets. The US, I mean, naturally they're optimists by nature, and this is the big overhang for the market. And I think you saw it, just in the reaction to Apple, where Apple's reaction probably wasn't all about China. It was more to do with probably the cost of their goods, and that's why their revenue target is a little bit short. But it was all blamed on China. So you can see that if the market gets the answer it's looking for in terms of trade, then I think that's going to be a big boost. I'm just not confident we're going to see that answer, Peter, in the short term. But he's a game player, and I think he's going to play it till he's got the outcome he needs for his base. This is a very political thing he's doing.
But Paul, I made the point today that he can't afford a stock market crash in a recession before the next election. So it seems to me he needs to get something done on the trade front that won't send the market down. Yeah,
but it's not yet affecting his base, Peter. So I think he plays this as long as he can until he gets the outcome. I mean, there's some more urgent issues probably to deal with in terms of the shutdown, and just getting a victory there or being able to claim a victory is probably what's important.
Okay, assuming you agree that the Trump trade, but you're not controversial, do you disagree with that?
Well, I think the bigger question is that we're likely to see a slowdown, at least in terms of earnings growth in the US.
Well, that's what I go, the company profit story,
implications for the US economy. I think we're debating whether we're going to see a slowdown or a recession. So it's just how deep that slowdown is going to be. And I guess Trump doing a deal with China still means that we'll probably see a slowdown in the US. It just won't mean that it's as deep as the market's anticipating at the moment. So look, I think this is a natural turning.
Before we go to the break, I want to go to our next slide, which tells us the reasons to be optimistic, and we'll talk about this when we come back, and also look for stocks that you guys might like. First of all, from November to April, historically, is a good time for stocks. Secondly, the third year of a US presidency is a great year for stocks. And finally, the Bank of America bull and bear indicator is actually at a real scary level, which has tended to be a really positive sign for stocks, believe it or not. We'll talk about that when we come back from the break. Welcome back to Money Talks. I'm Peter Switzer. I'm joined by Julia Lee from Bell Direct and Paul Rickard from the Switzer Report. And we are talking about whether this is a buying opportunity for stocks, because the market has sold off very strongly, started to sneak back a little bit, but the question is, when do you get in? Now, one thing I brought up just before the break was the fact that November to April is historically a great time for stocks. The third year of a presidency is usually the best year for stocks. And also the Bank of America's bull and bear indicator, it was at a very scary level, which historically has been a good contrarian sign to get in. Julia, what do you say about that?
Look, I've had a look at, well, in Australia we hadn't had a recession in a while. It's been 27 years, but generally looking at sort of recession and how markets react around slowdowns, and the market tends to react before the slowdown, and then the time to actually look at buying is when the slowdown is happening. So the market's always forward-looking. So the thing about 2019 is, even if you start to see economic growth moderating from the US or Australia, it's in those times you're looking at the opportunities, and this is when the real wealth is made. So look, don't be scared of the volatility. There's a natural cycle to markets and natural economic cycles too, and the turning of those points is a pretty exciting time, I think,
it sure is.
Investors.
Paul, so if you agree with Julia, would you be unhappy to buy stocks that you like now on the basis that even if they dropped a bit, the biggest part of the drop's probably out of the way, so you'd rather be in and then ride it up?
Yeah, look, I'm with you, Peter. I don't think this is an Armageddon, and I think we've already seen a pretty big drop. There's probably, as I said, I'm a little on the sidelines because I think we've got enough uncertainty there with particularly President Trump and the election coming locally. But I think badly beaten up stocks, and there are a lot of badly beaten up stocks.
Good quality, badly beaten up stocks. This is the time to be nibbling, put away. Don't be too pressured if they go down another 5%. That's going to happen, right? But because you're never going to pick the bottom. But I think this is the time to be looking at quality stocks that have had a big knockdown. This is there are some good buying chances, opportunities there. Okay, well, let's go to that, Julia. Every week you come on and give us your favourite stock and favourite sector. But I said to you, given what your view is that 2019 ultimately will be a better year for stocks than 2018, that's the conclusion I think you've been saying. What stocks do you think look really good at this point in time? Well,
for the first quarter of the year, and I've been positioned quite defensively for the last few months, stocks like AGL Energy, which were oversold in 2018 and have started to climb back. I think there's still some more in the moves there. The Sydney office market has been very strong, and the thing about the office market and the rental market in that space is that you have these multi-year contracts, and as they roll over, you see the earnings effects start to come through, and those rental yields looking pretty good, and you've started to see that, but look, that's going to continue over the next 2 financial years. So Dex's property is looking great in that area, Charter Hall as well. The flip side is that you need to keep on having a look at the capital appreciation side, which part of it's driven by the business environment. And I think one of the most exciting things to be looking at the moment are counter-cyclical stocks. We have been through a pretty bad drought, and the time to look at agricultural stocks is in the middle of
when people are at their most scared and frightened.
Yeah, and you tend to sell when the conditions are good and the crops are good. So stocks like New Farm, I think, are pretty exciting for longer term portfolios at the moment. And look, you've already seen some takeover activity in that agricultural space, because I think there is an opportunity there being counter-cyclical. And look, BlueScope's the other one that's been under a fair bit of pressure because...
Now, a lot of people have lost money on BlueScope, and then all of a sudden it's done fantastically well and it's come off the boil.
It's come off the boil severely, down about 40% over the last 6 months, as you can see from that chart, and that's because the hot rolled coil price over, not only in the US, but over in China, has been declining quite sharply. So look, that started to stabilise around about 740, and of course you're really watching China during the key winter season, because if you see pollution and smog, the Chinese government this year hasn't done a blanket ban over the steel manufacturers for 3 months as we saw last year, but if you do see those pollution levels creep up, then they could perhaps selectively start to shut down some of that steel production,
which will help BlueScope,
which will help the supply side of the equation.
Okay, Paul, you've heard Julie's. Are any of those ones on your radar?
Yeah, the two of them certainly are on my radar. Both Dexus, I think, at a lower price, and AGL. I think it's time to be just a little more defensive. I think what we are going to see in 2019 is yield come back into play. And that's interest rates in Australia aren't going up, Peter, and so and we're looking like the Fed, is it going to stop, at least pause for a while in the US? So interest rate sensitive stocks and yield sensitive stocks will become more in vogue in Australia. Right. I think the brave call at the moment is to be out there buying the banks. I've been bullish on banks for a while and wrong. Yeah. We're going to find out exactly what damage is coming up on the 1st of February, but I suspect that it's going to be fairly benign. Most of this is now priced in.
So you're saying that the market's probably overpunished the banks because...
Well, it's overpunished the banks for lots of reasons. The Royal Commission worried about the housing market. Look, the housing market is not going to go through Armageddon either. So I think there's a lot of negativity built into the banks. There's capital ratios are strong.
And APRA has eased off on
APRA's eased off
to investors.
Yeah, look, and so I don't think. I think the challenge for the banks is how they cut costs. Right? Yeah. They can't grow income much. Can they cut costs? I think there's going to be some opportunities in the banks, but I think that some of the dividend-paying stocks that have come off in price. Julie's mentioned a couple there in stocks like AGL, Dexus. I think you've thrown in things like in some of in the healthcare sector, Helios, the old Primary. There's some stocks out there. There's a little bit of value out there. I think even the retail space. A brave calls JB Hi-Fi, which has got all of a sudden in January we've seen the retail stocks get carved up again the last couple of weeks. On the strength of Kathmandu, all the data I'm seeing, Peter, is the economy's doing okay. So I think there's a bit of value there, but it's probably just to look at yield, look at great quality stocks paying good yields. I think are going to be in demand in this part of the year. To wrap up, I've got a quote from a gentleman by the name of Sam Stovall, who I interviewed when I took our television program to Wall Street. He was working for S&P in those days. He's now with another firm. But this quote is really interesting. In greater than 85% of all declines of 5% or more of the market since World War II, the market got back to break even in an average of only 4 months or fewer, which basically is what Julia was saying as well, that you don't expect it to happen immediately. It's a bit like the old Rachel Hunter. It won't happen overnight, but it will happen. Pete,
these opportunities don't come every year. They're multi-year type of opportunities. So when you see that volatility in the markets, it's all about the markets being too pessimistic, and as the picture gets brighter, the cycle tends to turn. And I think the banks are a good case in point. At the moment, the banks are pricing in 4 to 5% mortgage growth this year, but say those rates of growth go up to 7 to 8%. Well, what's the market going to reprice that change? Usually, the share prices of the banks would rise to reflect that positive change. So it's about the incremental changes in information as well. So I guess if we do see lending loosening up a bit, that would be a positive. Okay, now we're going to another break. And when we come back, we will look at the other side of it. What could go wrong and how bad could the things that go wrong affect the market? Welcome back, and we're discussing the better year for stocks in 2019. That's what my colleagues, Julia Rickard then, Julia Lee from Bell Direct and Paul Rickard.
I'm flattered, Peter.
Yeah, Paul was her boss at one stage, so there is a close relationship. But what we do want to talk about here is, okay, they're optimistic. What could go wrong? What would they be watching for that would make them change their point of view? Julia?
Oh, well, obviously the Federal Reserve being too aggressive in raising interest rates because inflation becomes a threat in the US. And then from China, that, the slowdown that we're seeing in growth, that they're being too optimistic about the 6.3% that they're aiming for, and that comes in a bit low, and we continue to see that softness. So I think China's a key risk for Australia. Over the weekend, we did see that 1% cut to the reserve requirement ratios, which helped to support our miners to a nice rally today.
So they're stimulating the economy.
Yeah, but the problem is if those problems do do go on for longer, that would be a significant risk, not only for the Australian share market, but for the Australian economy.
Yeah, and even the global economy. Yeah, Paul.
Well, obviously, I think we mentioned President Trump is probably the biggest risk, but China, clearly. I mean, I think everyone in the market's still banking on the fact we started 2018 talking about synchronised economic growth in the major markets. By the end of 2018, we're talking about that's not going to happen.
Yeah, that's true.
But we're not predicting recession. And so clearly that the data in both the US and China, Europe is worse than people anticipate. I think we're looking for a softer landing. So some growth, enough to keep company profits growing, but not going in the other directions. I think that's probably the biggest risk.
Okay. One last thing. When the sell-off was at its worst in America in particular, the implication of how far that market was sold down and the PE resulted implied that US corporate profits in this upcoming quarter, which we'll be looking at soon, was 0%. Now, all of a sudden they say, hang on, that's wrong. It was, what, 18, 22% in the quarter before, and they were kind of expecting 8 or 9% growth. Is part of the reason for this because of the machines are taken over from man, algorithmic trading, computer trading, ETFs, all that sort of stuff? That means that we oversell and then we overbuy?
I do think there is, a momentum effect that's occurring in terms of market, but at the end of the day, markets are people and human emotions. And, during the global financial crisis, we saw the energy sector trading on a PE ratio of 6. But we've seen that in the 1970s as well, so it's not like we haven't seen that before in time. It just feels like the market reacts more quickly to conditions because we have the information at our fingertips.
And the algorithms often will say if a stock is down 5%, sell it. And once upon a time, a man or a woman who was a fund manager would say, hang on, will this go a bit further before I get in there and sell even more?
Look, I think the great thing about the markets is there's no guarantee. So look, whether you're using a computer or using your brain, look, the market is the market, and the market does react more quickly. So I think in terms of trying to price in information, there's certainly a quicker response. But the beauty of markets for me, Peter, is that markets do overreact, both on the upside and the downside. If they didn't do that, the excitement would be gone.
Paul?
Yeah, I think the one change from today versus, say, 10 years or 5 years ago is momentum trading. I think momentum is so much bigger. And I think we get some inexplicable movements in the day and within hours in the market.
Yep.
But the momentum changes pretty quickly, right?
Yeah.
So just everyone's selling a stock, eventually they go and cover it and it comes back again. So I think as for investors, you've just got to sort of put a lot of the noise out to one side. Over day to day, month to month, the market gets it largely right, but within the day, even within the week, you can get it horribly wrong.
For me, the scary thing is correlation between asset classes. In 2018, we were talking about synchronised global growth. Now we're talking about the opposite, synchronised slowdown, which is pretty scary to see as well. So I think it's the correlation not only between economies around the world at the moment, both developed as well as emerging, but also asset classes. And I think that's a scary thing. If you're looking to hide, well, cash rates are so low around the world, well, what do you
Okay, we're out of time, but I will throw one thing in, Julia, that when we start talking about synchronised slowdown, that's based on the guesses of economists, and being an economist myself, I know how accurate economists are not. Okay, that's the show for tonight. Thanks for joining us, and I really do hope we're right. As a group, we believe that stocks are the place to be in 2019, but you might just have to be slow out of the blocks. I'm Peter Switzer. Thanks for joining us on Money Talks.
This program proudly brought to you by IPO Wealth for the sophisticated investor.